The Todd Shapiro Show.
Time to hit the button!
On Canada Talks, SiriusXM 167. Stock Jocks with Genevieve Roch-Decter.
Hey, Genevieve, how you doing?
I'm good, Todd. Just back from a week on the road. Happy to be home for once.
Genevieve Roch-Decter is hanging out with us from Grit Capital, of course. Grit Capital really making a ton of news over the last couple of years in terms of working with public companies and helping promote public companies, but also helping it in a really sort of organic and genuine way and getting a lot of millennials involved. You'd done a stint on BNN for quite some time. Now you're helping us out every Monday, and we always really appreciate your time. What is the word? You were in Florida last week, and actually we just got off the phone with an individual named Lance Lambert from bovidegg.com. And he was telling us how there's a lot of hype going on right now in the cannabis industry in the United States. Is that what you felt?
Yeah, big time. We were down in Florida, which is one of the most important states as it comes to cannabis. And yeah, we did 3 dispensaries across the state. We went and visited, and everybody was very jazzed up. Right now in Florida, it's only medicinal cannabis that's allowed, so you need an actual medical card. But the buzz during the tour was they think it's going to go recreational, legal sometime in the next sort of 12 to 18 months. That's what all the management teams were saying. So if that's the case, the market could actually double. And it's very, very exciting down there.
Well, I don't want to sort of step on the toes of the little clips and bits we do just in case we're going to double back on it. But so let's just start, Bilal, with the hot stock sector of the week.
Hot Stock Sector of the Week.
All right, Genevieve Roch-Decter, what do we got?
All right, we're talking social media and making money on it. So Twitch, which is an e-gaming platform, it's a streaming platform, but e-gaming is kind of like the main thing that people do on there. So the streamers on Twitch made over $90 million last year, and that was up 30% year over year. And then on Instagram, content creators on Instagram made nearly $500 million last year, and that was up 50%. And I just read a survey that said that among young people today, they don't want to be doctors, they don't want to be lawyers, they don't want to be investment bankers, they actually want to be social media influencers. That's the most desired career among young people today.
Yeah, 75% of people who are like under the age of 12 years old said they wanted to be YouTube stars is one I read about like 2 months ago. And you know, this is a space I would say I'm really, really well schooled in and very familiar with, and even everything you're doing at Grit Capital and growing your Instagram channel, it's miraculous. Let me ask you a question. As much as this is all growing and Twitch is growing and Instagram's growing, and I think sort of people are still on the Snapchat and maybe of a younger generation, do you ever worry that people aren't getting real life applicable skills on these platforms?
What do you mean by that? Because they're in front of a camera?
Yeah, face-to-face conversations, dealing with controversy without sort of doing it through a platform. Actually, proper education, not just announcing or talking about headline kind of things, and also the real life applications and dealing with stress and dealing with duress and dealing with the part where, if you're not accepted by everyone in the world, well, it's okay. But online, if you're not accepted by everyone in the world, you might be very depressed by that if you had it at one point. So I worry a lot of social skills are going the wayside based on social media skills trying to take over that aren't actually real.
Yeah, I think there's a flip side to that. Obviously, there's a downfall to people like walking around, their high schools with their face in their phone, as opposed to, socializing and, doing the what's up in the corridor kind of thing. But I think the flip side to that is I think social media is teaching people that in any sector, it doesn't matter if you're in finance or entertainment or like in any job that you're in, selling yourself and your product and what you're doing is really important. Like being able to compel people to be interested in what you're doing is so important. And I think that social media is teaching people that you can do that and that you don't have to be like an actor and you don't have to be born with these skills. You can teach yourself these things. And I think it's also causing a lot of people to be able to explain complicated things in shorter formats. And if the downfall is that long format's going away, Well, I think it's just speeding up the sort of velocity of how information is disseminated. I think there's downfalls and there's positives and negatives to any of these technologies.
Genevieve Roch-Decter at grip_capital is where to find them. The sector of the week, which you just mentioned, is sort of the Twitch and online and social media. What sort of is that? Just before we get on to talk about the worst trade of the week, what is this like sector disrupting? What where if there's so much money going into that space, where is it taking money away from?
It's taking money away from the big broadcasters, so the big media conglomerates that used to run everything and used to be monopoly. So I think the first time in the last 12 months, more money has been spent on these social media platforms as opposed to the traditional big broadcasters that own TV stations, newspapers, etc. And so what's happening is that it's disintermediating the big guys that are in charge and making these smaller, more independent, more authentic brands and channels more, giving them more power. So it's like more power back to the people. In my opinion, everybody can have a voice, everybody can have a say, and I think it's just keeping the voices out there more accountable so that not one is being controlled by one political party or another political party or one Fortune 500 company, et cetera, et cetera. So the big guys are losing at the expense of the little guys, in my opinion, or girls.
The next segment we're going to do, which is very appropriate for today because it was the trade deadline in the NHL where most Canadians, especially fans of hockey, were glued to watching what was going on. And we'll talk about that a little later with Nick Alberga. Alberga, right, Bilal? Am I saying it right?
Yeah, Alberga.
Yeah, Alberga. I just want to make sure I'm saying that right from the SiriusXM NHL network. Today's worst trade of the week.
Worst trade of the day.
Of the day, whatever.
Well, it was actually of the week, but yeah.
Yeah, Bilal, we got to change that ID.
Okay.
So Kraft, the makers of I really love mac and cheese, So the stock was down 30% last week. I think it was down only 2% today, but they took a massive write down on a bunch of their acquisitions. So Kraft is the third largest food processing company in the world. And, they own everything from Oscar Mayer to the mac and cheese to Maxwell House. They own a bunch of brands. But what's happened in the last few years...
Don't forget about Heinz ketchup.
Yeah, and their Heinz ketchup is, their top line, their revenue isn't growing. And the company's done everything they can to cut costs. They have very efficient cost-cutting measures where they use this accounting system where every year their accountants in every department has to actually kind of renegotiate why they want these costs spent. So it's a very aggressive cost-cutting strategy. And it's worked on the bottom line, but the top line's not growing. Why that's happening is people have, they're fickle these days. They're not sticking to brands and brand choices as long as they used to. So, people like Warren Buffett that are investors in this company.
15 billion shares, right? Or 15 billion worth?
It's a massive, between him and the private equity firm 3G, they own a huge portion of this company. But they like to buy these big brands that have 100-year histories. But I think what this is teaching the market is it's not always safe to buy these big 100-year valued brands because when, people have shorter attention spans and they're more used to trying out new things, like the millennials, they might not want Heinz ketchup. They might want something that's more, healthier, organic, whatever. People are used to making more choices. This is really affecting their growth strategy. And so their growth is stifling. And that was quite apparent last week when the stock went down. They lost 15 or 20 billion in market value.
Warren Buffett, of course, who's one of the most infamous investors of all time, mentioned that he had absolutely no intention of selling the stake in Kraft. Is that to really make sure that investors don't get too fearful and sell off because he's lost so much money and he hopes that they'll creep back in? Or do you think a guy like that at this stature of his life genuinely means that and really believes that there's still an opportunity for growth within that company?
Well, he also said that he was absolutely not adding any more to his position. So he said he's not selling, but he's not adding any more. I mean, I think it just goes to show that, but Warren Buffett missed a lot of the technology plays. So he's not 100% right. But I think as you get older and older at his age, you like to kind of collect dividends and moving around billions and billions of dollars is a big exercise. So I think for a guy like that, he'll wait it out, and he's not going to sell on the day when everybody's selling. Certainly not, right? He might wait it out for a rebound and then trim his position.
Let's go to the finance term of the week.
Finance term of the week.
All right, the ABCs of finance with Genevieve Roch-Decter.
So finance term of the week, promote. What is a promote? When somebody says there's a big promote on this company or this story or this stock, what do they mean? What they mean is that a company issued a very cheap stock, like at a penny or 5 cents, 10 cents, just like very cheap, and they raise a bit of money, say $100,000 or $1 million. It's usually a very small amount of money. And then not long after, they go out and raise a bunch more money at a much higher valuation. So if they raise at $100,000 valuation, they might go out and raise at $1 million or $10 million. And that difference between the cheaper round and the more expensive round is called the promote. And essentially what it means is that the people that put in money are getting a promotion on the value of their stock without having done much. And I've talked about this a lot on the show, like deal guys and deal girls and people who do deals. This is a lot of what goes on Bay Street, is this sort of deal situation where, people get in really, really early, don't create that much value, and then they get like a huge uptick on the value of their stock. Now, this is not always it's not always for the worse. Like there's sometimes real reasoning why you would have a valuation discrepancy so close in timeline. Maybe the company got a license, whether that's a cannabis license or whatever. There's sometimes real reasons. But what I'm talking about is when there isn't a real reason and there's a huge uptick in value. It's called a promote. And usually the people compensated for that is because they're well connected and they're going to create a lot of noise about the company, et cetera, et cetera, et cetera.
Is this bringing a lot of resentment to some investors, though, when they find out this stuff? And I know you've done reports from Cedar, you even made a joke, the Cedar Bandits, and where you could disclose, because all of it does have to be disclosed, people who are in on early rounds and how long the tie-up period is. And, usually directors and all that stuff obviously have to have it in escrow. So they, some of the founders and people working within the company can't actually get rid of that stock. They got to believe in it. They can't just go and pump and dump it. But does it create a lot of resentment from investors? Do a lot of people not even really understand it still?
I think like the retail, like the kind of average crowd at home that's not in finance, doesn't work professionally in this sector, wouldn't know that, because like how would you really understand how prevalent it is? But I think the people who are professional investors, they just like assume that stuff's going on. And one of the first questions that always gets asked in these meetings is, what's the promote on the stock? Like where were the cheap rounds done at? And so it's just a due diligence question that happens. And it's kind of just the cost of doing business. It just happens. There's nothing like illegal about it. It's just these people are willing to take a risk early on and put money in. And, they do some legwork to actually put the deal together. So like I said, it's not always a bad thing. What I kind of steer clear of is people who are doing this with no intentions of actually building a real company, right? Like they're not actually going to go and buy real assets or real companies. They're just going to try and create sort of like, pie in the sky. This could be a company, but it never turns into anything. Those are the things you want to kind of steer clear of.
Yeah, it's very frightening. People just do a raise and they essentially spend money from that raise. They're not necessarily spending it personally, but they might not be doing it for the best interest of the shareholders. My last question when it comes to the promote, are there deals, though, that just go bad where people actually go in really early, get in on these early rounds with the idea of doing everything right, but they can still fall apart? Like there's still risk for these people on these early rounds as well, correct?
For sure. And like that happened, case in point, last year with the whole crypto sector. So a lot of these deals that got put together within like, say, 4 to 5 months, and they all had good intentions. They were going to create their crypto mining operations or exchanges or something in blockchain, and they did have good intentions. Some of them, not all of them. And then within 4 or 5 months, all that money went to zero, So yeah, it happens. And that's the cost of doing business. And those people, a lot of the times that are in these early rounds are professionals, and they're used to making money and losing money. And it's a game that they understand the risk reward.
All right, let's find out what the most fascinating finance stat of the week is.
Stat of the week.
So last year, an independent investment bank called Canaccord Genuity actually beat all of the banks, so RBC, CIBC, BMO, all the top 5 banks in equity financings. So they raised about $3.2 billion last year. And most of that, I'd say like about 80% of that was raised through cannabis deals. So like this independent firm decided to get aggressive on cannabis, and it really paid off. They made a lot of money for themselves, for their clients, for their investors. And it's just funny to watch now because all the banks, well, not all of them, but some of them are now starting to jump on this bandwagon and want to get into the financings because they see how lucrative it was last year and they missed out.
That's a great stat. And quite candidly, I've invested on early rounds in some cannabis companies through Canaccord, and I think 80% of them went well. It's not like there were a ton, maybe 4 to 5 deals, one not so much, but there's still risk on those early rounds, and maybe I'm a case point to that. But congratulations to them because it was an emerging industry, an industry that banks wouldn't get into and people were afraid of, and people were afraid of even traveling if they were investing in the industry to the United States and things like that. And we're seeing the same thing now south of the border where banks aren't really getting into these deals, but there's a couple starting to talk about perhaps doing it, correct?
That's right. Yeah, there's a couple of firms down south, and it's still federally illegal. Like to be honest, I'm a little spooked every time I cross through customs. Not that I'm doing anything wrong, but at any point they can give you a lifetime ban if they want to. Get caught up at the border on the wrong day politically, and you could be a target. So I always try and be a little bit careful when I travel.
Okay, let's go to something that I think Genevieve Roch-Decter hates about finance.
Finance to hate.
Yeah. Okay, so there's something called handcuffs on Bay Street. Okay.
Sorry, your phone cut out for a sec there.
Okay, it's called the golden handcuffs.
Huh.
And this is what happens. Okay, so finance is a sector where you can make a lot of money. These jobs are very lucrative. But what I often see happen, and I find it very sad for my friends or colleagues or people that I see around me, is that they make a lot of money early on and they get tied into these jobs that financially are very rewarding, but then there's no meaning for them in the work. But by the time they kind of realize this, maybe it's like 10 years down the road, they're married, they have kids, they have cottages, they have ski homes, blah, blah, blah. They've got a lot of money. Their burn rate is very high, and they can't get themselves out of it. So it's not like they can quit this very high-paying job, and this is why we call it the golden handcuffs, because you're kind of shackled to that job. They can't really get out. And so I see a lot of, depressed people in finance that are not living out, their kind of their authentic, true, what they want to create inside, of them, the burning whatever that they have. They traded it in for making money. So I see that a lot around me, and I feel bad. I don't know what the answer is, but that's one of the things I don't like about the industry.
I actually really love that you brought that up and mentioned that, because losing sort of a human side can't ever replace what money can bring. And on a way much smaller scale, I mean, Genevieve Roch-Decter, I'll share, a little story myself, is that even just me being really focused on the markets, forget about making money if I have or haven't, and some days I do and some days I don't, but not really being present, and that's a lot of it. It's not even just like making money and then having to keep up the lifestyle, but the markets are pretty much like I don't necessarily want to call compare them to a casino, but every Monday at 9:30, you're jonesed and your adrenaline's going to find out what is going to happen with the companies you invest in, and you might at 8 o'clock on the Sunday night start prepping and reading, and there's a lot of work that goes into it, and trying to figure out and reading forms and reading actual reports and quarterly reports and all this kind of stuff to see how you'll do. But it can be a very all-consuming gig. So I just sort of caution people, even on a smaller scale. Let's call it the bronze handcuffs. But if you're looking to get into finance, just make sure that you don't lose those moments of being present. And I'm even victim of that, and I'm trying my best to sort of live more in the now and not only be concerned every second. But sadly, every second can count, where a stock can jump 15% in a minute and then go back down 25% the next. So that's the tough part.
Yeah, you really have to keep your ego in check in all this, because it can get bruised so easily. And so, what we always say at our firm, Grit Capital, when we're looking to hire people, is that we're looking for people that are really passionate, because at the end of the day, when you do make those investments or work with those companies that don't work out, you have to get back up again and do it all over again. Find another client, find another stock to invest in, refine your thinking, get better at it. And you really have to have a passion for it because it'll tear you down. It really will.
Well, on top of it, Grit Capital has pool parties, so you definitely live in the moment and bring people together at times. So we'll give you credit for that. And one of the things that's my favorite part about Genevieve Roch-Decter is her positivity, and that's why we always end this segment on things that she loves about finance.
Finance to love.
All right. So this is about, I don't think there's any other industry in the world where you can get as quick a feedback, like we were just discussing, on your kind of thesis on something. So in finance, you got the stock market. And, in some ways, yes, it can act as a casino if you're looking at really speculative investments. But what I love about it is there's no real other sector in the world where you can create an entire thesis around something, do your research, and then actually place an order, a bet, buy a company, buy a stock, and see how your thesis plays out. And, oftentimes, especially in the beginning when you're doing this, and I remember my first days as an investor back about 11 years ago, you make a lot of mistakes and you stumble and you lose money. But you get better and you're fine. And so that feedback mechanism of refining your thinking, I don't know of any other sector where you can do that as quickly and where the stakes are as high. And when the stakes are high, when it's money and it's real money, this is why we always say, play with only money that you can afford to lose. You can just get really good really quickly, or, it makes you realize that you really suck at this.
No, but
it's
that's a really good point. That's a good point for, I think, investors of all levels. And I hate to keep personalizing this stuff, but, you know me as a friend and you've known me for quite some time. And I've always, my whole life, I was a creative guy, never even thought about getting involved in the financial markets until a couple of years ago, meaning taking control of my own wealth. Whatever savings I had, I just, had it with a firm and, you'd get your 4 to 7%. And then you found out all the fees they were taking. And I was kind of getting pissed off. So, I feel like I learned pretty quick, but then I started questioning some of the things and decisions I was making as, markets would go down, especially in the cannabis space. But there's one stock in particular that I really, and I won't mention it on air, but I really, really loved it. I really loved the fundamentals. I learned everything to do with their business model, all the finances that were coming in terms of the revenues that they were making, their expansion plans, et cetera, et cetera. And I bought this stock, and it went down past the point of literally 60%. And I was watching people panic sell. And truth be told, and people could probably do your own due diligence, figure out what stock it is if they look hard enough. But just today, that stock is now basically back. Actually, it's higher than what I originally bought it back. But I held on to it because in my mind, the fundamentals of this company did not change. And I was kind of proud of myself. That was something that I learned for myself, not that someone could ever have taught me.
Yeah, no, that's a great point. It sounds like the pool party is going to be on you next time, but
I'm not up that much. I'm just over a little bit. I'll buy a couple drinks.
But that brings up a good point. When I started working in finance, it was fundamentals, right? So I got my CFA, which is all about numbers and valuing companies and cash flow and discounted cash flow. So I got that piece, which was okay, what is the value of this company? But then you quickly realize that you can't just invest with that one thesis. You need to add other things. Other things like what? You need to learn how to read charts. So I got my chartered market technician designation. So I got that. So I could start reading charts. And then it was okay, it's not just charts. It's how much money is actually flowing into stocks. And from where? Is it institutional money? Is it retail money? So it's a fund flow. So that became money moves stocks. So when a lot of people invest, the stock goes up. When people dump, it goes down. So there was that. Then it was a people game. It's okay, who and what investors are liking what sectors now? What investment banks if Canaccord's getting really big on cannabis, you want to be in that sector. So it became really more of an EQ thing, figuring out who's doing what. So all of these different things, all these different tools is what I've tried to amass over the years, the tool belt of investing. It's not just one thing. It's all of these things together that really create that gut feeling and make you a good investor because you're balancing all of these different things at the same time to come up to a decision.
And on top of it, a great broadcaster. I really appreciate all your help today, Genevieve Roch-Decter at grit_capital. Make sure you follow her and all the great stories as well. Fantastic stuff you're doing. You're really making finance really kind of interesting and fun for a younger audience who might not have ever done it. Of course, you still got the very serious, older, typical investors themselves. I wonder what Warren Buffett would say, however. But thank you so much. I appreciate everything and can't wait to have you back on the program Monday.
Sounds great. And follow us on Instagram, too, at Grit Capital.
Oh, is it Grit? Oh, it's at Grit Capital on Instagram.
Yeah,
Sorry.
Capital on
okay,
Instagram.
I got the wrong notes here. Way to go, Bilal.
That's the accurate Twitter handle.
Anything to make. Yeah, but it's the stories are on Instagram.
Yeah.
Okay. Well, thank you very much. I appreciate all your help today.
All right. Bye, Todd. Bye, Bilal.
Cheers. Talk soon.
This is the Todd Shapiro Show on Canada Talks, SiriusXM 167.